Thanks for clicking! Canadians are missing more and more of their debt payments as the delinquency rate rises to levels not seen since 2009. This according to a new report coming from Equifax. Yeah, according to the report, at least 1.4 million people missed at least one credit payment in the first quarter of this year. And while the report points to current uncertainties as the reason for the surging delinquencies, a closer look at the data, dates, and context shows that it might not really be the Trump tariffs, for now at least, causing the delinquencies. It's everything that came before: the debt, inflation, and house prices.
You're a problem.
So what I want to do today is go over the report from Equifax, take a look at what the credit reporting agency says is causing these surges in delinquencies, go over the historical record, and then discuss some implications for interest rates. Speaking of interest rates, we do have a big week coming up next week with the Bank of Canada set to make its interest rate announcement on Wednesday and hold a press conference thereafter. We will obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. As mentioned, the new report coming from Equifax stresses the worsening financial condition on the part of Canadians, showing that 1 in 22, or 1.4 million people, had missed at least one credit payment during the first quarter of 2025. The surge in delinquencies was worse for those who don't already have a mortgage, up 8.9% from last year, versus the 6.5% who do currently have a mortgage. This falls in line with what we heard from the Bank of Canada earlier on in the month, when it noted that signs of stress were higher and accelerating among those who did not already have a mortgage.
You're a real problem.
Yeah, but it makes sense. Those who do have a mortgage, those who have benefited from the printer-fueled surge in house prices over the past few years, can hide some of their debt by consolidating it at renewal, something Equifax says has been happening quite a bit, with new mortgage originations up 58% since last year, and 28% of new mortgages in Ontario, BC, and Alberta switching lenders to do so. So the mortgage renewal comes up, borrowers switch lenders, consolidating some of their debt into a new mortgage, making that mortgage payment that's set to be at a rate about 50% higher than it was over the past 5 years, say about 3.35 in March of 2020 versus 4.59 in March of 2025, a little bit more manageable. With that said, even with these debt consolidations, Ontario isn't looking that great, with mortgage delinquencies up 71.5% since this point in time last year, and non-mortgage delinquencies, late payments on non-mortgage debt, up 24%, both the highest in the country, followed by BC, with a 33% increase in mortgage delinquencies there as well. And while I don't think it's any coincidence that Ontario and BC, which also saw the biggest increase in house prices during the pandemic, are also seeing the highest level of mortgage delinquencies, Equifax sees things a little bit differently, noting that economic uncertainty continued to impact credit usage and consumer financial health across Canada during the first quarter of 2025. And CTV summarized. Sort of.
Canadians are missing payments on their mortgages, auto loans, and credit cards.
The report from Equifax Canada blames economic uncertainty, rising unemployment, and the high cost of food and housing.
Which, and it might seem like a small point, I promise it's important, Equifax does not explicitly say that high unemployment and high food prices are the reasons for the current delinquencies. It says that they will be, noting that headwinds will likely persist, such as rising unemployment and rising food prices. And I say that this matters, this small point about what is causing current delinquencies versus what will cause current delinquencies, as we really shouldn't be seeing this many delinquencies given the current state of the economy. The last time non-mortgage delinquencies were this high, says Equifax, was back in 2009, during the aftermath of the global financial crisis, which is definitely concerning, as the unemployment rate back then was 8.4% versus the 6.7% that we had during the period for which Equifax is reporting. So we really shouldn't be seeing this high of a level of delinquencies when the unemployment rate is only sitting at 6.7, far lower than 2009's 8.4. a point that is even more concerning considering a recent report from TD that said Canada could lose 100,000 jobs in the upcoming recession. According to TD, those job losses would bring the unemployment rate up to 7.2%, meaning even with 100,000 less jobs than we have right now in an unemployment rate 0.5% worse than it was a few months ago, Canada's economy would still be in far, far, far better shape than it was in 2009, when it had the exact same amount of credit delinquencies.
Everything's cool right now. Might be some problems later.
And the data just doesn't support the narrative that this is because of the Trump tariffs. People don't stop paying their bills because they're uncertain about what's going to happen 6 months from now. They stop paying their bills because they don't have any money. Rather, if we look at the data, the reason for the delinquencies is the debt combined with income, add in a bit of inflation, and limited central bank options. Household debt to GDP in Q1 of 2009 was sitting at 89.4 compared to the 102 at the end of Q4 2024. Meaning Canadians have a lot more debt relative to the economy than they did the last time delinquencies were that high. They were much more apt to pay their debts, with debt to disposable income sitting at 162% compared to the 172% in Q4 of 2024. So Canadians were much better apt to service their debt back in 2009 than they are in present days, a point that was largely true before President Trump was even inaugurated. Now, let's move on to inflation, and in Q1 in 2009, inflation had risen by 9.5% for the 5 years prior. And in Q1 in 2025, inflation had risen by almost 20%. During those same 5 years pre-09, food was up 18%, shelter was up 17%, fast forward to now, and food was up 27% and shelter was up 28%. Food and shelter, both of which, unlike debt, aren't things that people can choose not to have. And all of that was pre-Trump 2.0.
I understand why it happened. Everything was going so well. I thought.
And finally, let's take a look at the cost of borrowing. Back in 2009, interest rates from the central bank were basically at 0, with prime coming in at 2.25 versus the 4.95 that it's sitting at right now.
I just thought of something.
Yeah. Free money works until it doesn't. The central bank right now would have a real problem lowering rates back down to 0, even lowering rates down to 3, because of those aforementioned inflationary pressures. And as to how the US fixed problems back in 2009, printing up money to buy bonds, sending yields and mortgage rates lower, is a prospect, for right now at least, to which the bond market would not be responding overly well. Again, that's due to the ongoing built-up deficits on the part of the United States, a problem, as we've talked about before on this channel, that far preceded President Trump. So, Canada's debt to income has exploded higher over the past 16 or so years. Inflation has exploded higher over the past 5 years. Central bank options are very much limited, and they're limited in the United States as well, even more importantly, all problems of which far preceded the election and the inauguration of President Trump. Now look, I'm not at all a defender of President Trump.
How dare you?
I also don't not think that he's a once-in-a-generation genius who's going to single-handedly steer the world back on course through his unprecedented brilliance.
How dare you?
But all of these problems, massive debts, huge increases in inflation, lagging incomes, which are manifesting themselves in Canada's surging delinquency rate, as many have been predicting for quite some time, even while others were trying to make the problem worse. These were all problems well before President Trump took office. If you remember, David Rosenberg on this channel less than a year ago in August of 2024, well before the election of President Trump, was warning about just that.
We have a crisis on household balance sheets. How did we get here?
Now, the Trump tariffs and the resulting unemployment are obviously going to be a big problem moving forward. But they weren't a big problem during the first quarter for which Equifax is reporting. The Trump tariffs against Canada were only in effect, and even then not really, for 1/3 of the time period under question. So, as this drags on, as the economy continues to worsen and the powers that be continue to remind us that this is all Trump's fault, the same powers that be that told you could go into debt ad infinitum without consequence and Canada could support $25 million house prices.
Sounds reasonable.
Just remember, they're trying to cover themselves for past sins, using the president as a convenient scapegoat. All of these were very predictable problems that were going to be coming up in 25 and 2026, regardless of who was president. With that said, we will obviously continue to track how this all does play out on this channel. Make sure you click, like, and subscribe if you want to get those updates. But for now, thanks so much for watching.